Morning, ladies and gents. Simon Brown here, and I'm doing today's presentation. We're going to be looking confused with EFT-related funds. They are pretty much, as they say on the sticker, exchange traded. In other words, they're trading on a stock exchange. In this case, that stock basket of shares which an individual can invest into, and you make one purchase and you get that full basket rather than having to buy individual stocks, as the case may be. So collective investment schemes, that is the overriding act, and it covers exchange-traded funds. It also covers unit trusts as well as hedge funds. And that puts in place the rules, the expectations for investors, and understanding what we can expect, what sort of permissions we'll have, and the like. So they're regulated. They're not some fly-by-night at all. Many of us would have heard of unit trusts. They've been around in South Africa since the 60s. In the case of exchange-traded funds, we got our first in South Africa in late 2000. It was the Satrix. And the fact that they trade on the JSE. So unit trust, you buy what we colloquially in the industry call over-the-counter. Here what we've got is an ETF, trades on the stock exchange. You would buy it via online share trading, standard bank, either within the internet banking or the online share trading platform. And there are, as things stand right now, over 100 available different ETFs. And that sounds like a phenomenally large amount, but 2 points I'd like to stress. One is we have some duplicate, but they'll have different fee structures, and we've touched on those a bit as well in previous webcasts. And also, if you look at the unit trust space, I mean, there's in excess of 1,000 unit trusts. So, for instance, methodologies such as could be an index of the largest stocks. I've referenced the top 40. That is an index of the 40 largest shares on the Johannesburg Stock Exchange. It could track financial stocks. It could track offshore, mid-caps. It can track any sort of index methodology, which means we know exactly what goes into it. And that's what we talk about when we talk about the, a basket of shares. So the top 40 is literally the 40 largest shares on the JSE. And what we get is we buy that basket and we get those 40 shares. Now, we could go and buy those 40 shares individually for ourselves, but two things. Firstly, we've now got 40 sets of transactions that we have to do. Each of those is every 3 months, some indices every 6 months. What they do, if we're looking at the top 40, they're the 40 largest stocks. Well, what happens when one of those stocks falls and is now maybe only the 45th largest stock in the market? Well, at the end of the quarter, they kick that one out of the index and they bring the new stock into the index, the new sort of up-and-coming number 40 on the list. And that'll happen automatically. You don't have to do anything. You own the basket of top 40 shares. As those top 40 shares are changing, your stocks within your basket, within your ETF are changing as well. So ultimately what they give you is market performance. When markets were crashing back in March as the pandemic was and subsequent to that, we've seen our local market get back to the highs for the year. And in fact, we've seen international markets in the US, you don't have to employ actuaries and fund managers and the like. Simply all you need is to decide what the index is you're going to track. There will be an index manager, be that the FTSE JSE, S&P, MSCI, whoever might be. There's a number of index providers, 1% upwards to the more expensive. So very, very low fees and no performance fees because they're not designed to beat the market. What we do see is that the passive beats 84. Google, you will find the reports they do. They do them for a number of different markets, including South Africa. And put it the other way around, it means that only 15% of the active managers actually beat the market. And the active is your classic unit trusts, although you will get index tracking unit trusts at the same time. And the unit trusts beat what the market is doing. In other words, they're trying to beat, in essence, what the passive ETF is trying to do. And some of them do, but only 15% of them do. So it's truthfully a fairly get you that performance that you're looking for. Because when you're investing into the market, you're ultimately looking for market return, and it's a great place to be invested. The active says, well, market return's fine, but how about I give you a couple of extra percentage points? The problem is, can they? And the stats say quite simply that over the long term, they tend, well, some of them do, but the majority don't. So it becomes a challenge to try and determine which are the ones that will outperform. In the exchange traded space in South Africa, as I said, we've got over 100 of them. Financials, the industrials and the resources focus on preference shares. In the offshore space, we can buy them in the Nasdaq, the S&P 500, the developed world, Japan, China, UK. These offshore ones is that you buy that ETF. Let's say we buy the S&P 500 from One Invest. You buy that ETF. You buy it in rands. They take your rands, they convert it into dollars, and then they ship those dollars to the US and they buy you the stocks that make up that index. So you've had to be the shares as they move. And they're moving. Market opens at 9 every weekday, closes at 5, and during those 8 hours of trading, that index will be moving relative and staying at, so that ETF will be moving and staying at the level of the index, essentially trading at fair value. In the offshore space, you'd have both the index, the S&P 500. You'd also have the currency. So if the S&P went sideways for a period of time and the rand weakened from, say, 17 to 18 rand to the dollar, you would actually see an uplift in your ETF. Of course, if the rand strengthened from 17 to, say, 16 to the dollar, you would actually take some of the shine off your ETF as the currency was working against you. So you've got two drivers in the offshore. What's also important is, although it is an offshore investment, because you're doing it in rands in the JSE, and because ultimately when you sell, you will receive rands, it's not part of your offshore allowance. So it's no impact on your offshore allowance. If you've got money offshore, you can open up a Standard Bank web trader account, and there are ETFs in that, and you can buy those in dollars, no problem. Local and offshore government bonds. We've got cash. There's a cash ETF from ABSA. So we've got a massively wide range. And we can see the likes of Narina Fisser, who will then take the view of, well, they're going to build a portfolio. They're going to construct one, put it together, and make it all sort of fit into its bits and pieces and have different components. Have some commodity sitting in there, have some bonds, some property and the like. But we've certainly got the choice and the ability to manage it as we see. We've got top 40s from a number of different issuers. The holdings will be the same. Naspers, which is obviously the holder of Tencent, large British American Tobacco, which is actually a UK company. You can see it says PLC, but it's an inward listed. Truthfully, Anglo American also, and BHP Billiton PLCs. We've got First Rand, which is obviously the banks, Mondi, and then Goldfields. And what's interesting here, we've got a fair different blend of shares here. And what's most important perhaps is that, for example, Goldfields, if we had looked at this a year or two ago, heck, if we had looked at this 3 or 6 months ago, Goldfields wouldn't have been in the top 10. It would have been in the index. But as that share grows, it sort of gets elevated in the index. And so we get more of the winners, 500 largest stocks in the US, Microsoft up front, then Apple, Amazon, the Facebook A's, Alphabet A and C shares. That's essentially Google, Johnson & Johnson, Berkshire Hathaway, Visa, and Procter & Gamble. You will note the percentages on the side are smaller because they're 500 stocks. So, your big stock is 6%, whereas our big stock is running at 22.5%. What you'll also note is a lot more tech in the S&P 500, and that's not surprising at all. But we've still got, for example, Johnson & Johnson, Procter & Gamble, and of course it does go all the way down. There are ultimately 500 shares in this particular index making up the various different stocks. And again, every quarter it gets rebalanced, the quantities will be changed, and any of those falling out the bottom get deleted and new ones get added in. ETNs, they're very similar to the ETF. The difference being is that the ETF physically holds the shares. So if we look at the top 40, the One Invest top 40 ETF literally holds those shares. It's got the Naspers, the Billitons, Richmonds, etc. It has those shares. Whereas an ETN doesn't physically hold the shares, it will be using futures and the like to replicate the price of it. This does mean that they cannot be included in a tax-free account, and I'm going to touch on tax-free in a moment. And we did do a presentation just 2 weeks ago, which you'll find on the channel, focusing on tax-free as well. Usually your ETNs are commodities. We've got West Texas Intermediate Oil, wheat, copper. We've got currencies, dollar, euro, sterling. And we've got corn. And the reason is that they're in an ETN because it's just not practical to try and hold those as physical. So what we do is we create the ETN, or what we, the issuers, do, and you then get that price. So again, you can take it even further than just the sort of equities and listed property and the like, and you can go into some more niche. I mean, rhodiums and the like at the same time. The main issuers in South Africa, One Invest, which is an amalgamation of Standard Bank, Liberty, and Stanlib. We've got Satrix, who were the initial back in 2000, Core Shares, Signia, Absa, Ashburton, Cloud Atlas, and First Rand. So we've got a bit of competition. As I said, on the S&P 500, the top 40, for example, we've got, 4-5 different ETFs issued over the same index. They've all got the same sort of holdings inside them. So what differentiates one from the other? Well, the cost to you as the client. Essentially, they're looking to then reduce their costs to make that a more attractive investment, so you'll pick theirs. Retirement annuities means is in their offshore. Remember the limits on the tax-free account, 36,000 Rand per year per individual. That year runs March to February. Again, there will be a video and when. I run a monthly debit via AutoShare Invest that sits within the Standard Bank internet banking. And what you've really got there is a simple and low-cost way to buy them. So I run a monthly debit on my preferred ETF, and every month it triggers, and I pick up some more. And the way I've structured my portfolio is the base of my portfolio, about 56% of it is all ETFs. And then on top of that, I'll put a couple of shares. I'll have some trading activity. With some people, a colleague of mine, she's running 100% of her portfolio is ETF. You come back in 10 or 20 years and you see how it's performed. We'll leave that there. Remember, Mondays, Wednesdays, Fridays, we've got the webcasts 10:30. They'll also be on our YouTube channel. So questions and the like. Cheers all.